My name is Josh Strittmatter, and I am a financial planner. I own my own firm, Strittmatter Wealth Management Group. We work with a lot of Lockheed retirees, and we've been working with Lockheed retirees for the last 20 years. So we teach different classes about Lockheed benefits. So this is our retirement maximization presentation. We will be sending this out after today's meeting for your, if you'd like to peruse it again. And I'll be taking questions. Let me make sure I've got the chat feature turned on here real quick so that if y'all have any questions, you will be able to ask me. And it looks like we have the chat feature turned on. If anybody want to test that, you are more than welcome to do that now. So this title of this presentation is Lockheed Martin Retirement Maximization, how to not miss out on what you are entitled to and get every last penny you can get before your retirement countdown clock. And you know you have one, shows zero. So again, I'm the founder and CEO, been a financial planner since 2003. We do a lot of planning with Lockheed retirees. I'm a certified financial planner and a certified retirement counselor. Kelly's also my partner, and she does a lot of work with us as well, with a lot of retirees as well. And our team does lots of planning across the Metroplex, and we do financial planning in lots of different other areas as well. Combined 38 years experience. We're all certified financial planners. Today's information is not meant to be legal or tax advice. It is purely educational. So please talk to your licensed representative before you take action. And our course outline is here. We've got, we're going to talk about some, they're not so recent, but some changes that have happened in the past. We're going to talk about the Lockheed Martin Pension, how it works. And then we're going to talk about a specific strategy for the Lockheed Pension so you can get more out of your pension. We're going to talk about the Lockheed Martin 401k and some strategies around the 401k. We'll talk about the retiree healthcare plan as well, some portable insurance, the top 10 retirement mistakes to avoid, and then how SWMG, that Strittmatter Wealth Management Group, can help you retire. So starting off with the pension. So for those of you that still have a pension, that pension closed in 2006. To all new employees, they froze the pay component of it back in 2015, the end of 2015, and then they froze the service component of it back in December of 2019. And on January 1st of 2020, they began giving an automatic 6% contribution to all employees to their savings plan. And that was to offset that freezing of the pension. So just quickly, what is a pension? It's also known as a defined benefit plan, provides a specified monthly benefit retirement to eligible employees. The Lockheed Martin Pension Plan calculates the benefit using a formula that considers factors such as salary and years of service. And then for Lockheed employees that are eligible for benefits for a pension, they're eligible once they've reached 5 years of vesting service or they turn age 65 years of age. So what's the difference between a defined contribution plan and a defined benefit plan? Well, defined contribution plan gives you a specified amount that's paid to you monthly. And the benefit is based upon the amount contributed. I'm sorry, look, the defined contribution plan is where I'm starting. The contribution amount is what you contribute, and then your employer will provide a match. So Lockheed provides the match of 4% when you contribute 8%. And then this provides an individual account that you can monitor. Both you and your employer can contribute. It's based on a percentage of your salary. And then you're responsible for your own investment selections. And then your income, or what you were paid out from it, is taxed as ordinary income when withdrawn. And then mandatory annual distributions must begin at age 73. That's new, by the way. That used to be 70.5, so that new age is 73 for required minimum distributions. Defined benefit plan, it's a calculation using your years of service, Social Security breakpoint, average income, and accrual rate. You are not required to contribute to that plan. Your employer does that on your behalf. And then participants are not responsible for investment selection. So The employer makes the investment selection. And for those reasons, that's why many employers have gotten rid of those plans, is they didn't want the responsibility of investment selection or being the sole contributor. This is taxed as at ordinary income when you withdraw it, and you have to start your pension by the age of 73 now. So that's the new mandatory age. Advantages and disadvantages of these plans. This is a defined benefit plan. The advantage, and the employer is responsible for providing retirement benefits. The employee knows the retirement benefit amount in advance, so you can do a calculation and determine what your amount's going to be. Doesn't depend upon your ability to save money, so they do it for you. No investment risk. They take on all the investment risk. Plan assets are managed by professional money managers. It grows tax deferred, may offer cost of living adjustment. The Lockheed Pension does not. And then the Pension Benefit Guaranty Corporation insures most pensions in case of default. Disadvantages: no individual accounts are established for the employee, so you don't track a specific account. May only provide a portion of the funds needed for retirement. Plan is often difficult for employees to understand. Usually doesn't benefit employees who leave before retirement, so you have to wait until those vesting timeframes. Benefits are typically not payable until normal retirement age. And then most plans do not permit lump sum payments at retirement. And by the way, normal retirement age is age 60 at Lockheed. Your benefit calculation will depend upon what type of employee you are, but it's based on these factors. So final average pay, your Social Security breakpoint, the plan's accrual rate, your credited years of service. I'm going to show you an example here, but again, this may depend on which branch of Lockheed that you work at. This shows you that your final average pay is based on your top 3 earning years. However, that was frozen at the end of 2015. So those are the years that it went off of. So this shows you an example of this person's top 3 earning years. They found the average of 67,666. You have Social Security breakpoints. This is based off of your age. It's the maximum wage base, so the maximum amount that you pay on Social Security tax on your salary or on your income, and it goes back to when your birthday year, and it takes the average of all of those amounts. Your summary plan description has a table on it if you're interested in that to show you what that amount is, and then the normal retirement benefit calculation is a 3-part formula that looks at 1.25% of your final average pay up to the Social Security breakpoint. That's multiplied by the credited service up to 35 years. And then 1.5% of final average pay in excess of Social Security breakpoint, credit up to 35 years. And then 1.5% of final average pay times credited service over 35 years. This is, again, just an example. So your formula may be a little bit different than this, depending on which branch you work in. But this looks at a final average pay of $125,000. This person's Social Security breakpoint is $99,720. They go off of the last year of 2015, and then your accrual breakpoint is so up to the Social Security breakpoint amount is multiplied by 1.25%. In this case, that's $1,247. And then the amount above the Social Security breakpoint is just your salary minus the Social Security breakpoint times 1.5%. It's $379. And then years of credited service is 20, and then normal retirement age 32,520. And then divide that number. And by the way, that's the addition of the 2 calculations up here. You divide that by 12, and that's 2710. That's the monthly calculation. That's your normal retirement age benefit amount. So don't get too caught up in the calculation here. You can look at your summary plan description. That's not really the purpose of this presentation. The purpose of this presentation is to show you some strategies on how to take advantage of your pension and get the most out of it. And when you're choosing a pension payout, there are a few options that you're going to have to choose from. The first is the single life payout. So this is just taking an annuity payout, so an income for the rest of your life that would end at your death. If you, when you die, there's no survivor benefit. So there's nobody that gets paid after you after you pass away. So if you died in day 2 of your pension, you're kind of out of luck. And that's why they have the survivor payouts. So the survivor payouts is taken out over 2 lives, and then you have different percentages based off of that. So a joint and survivor 100% would pay an annuity amount to the owner of the pension. And then at their death, it would pay 100% of what they were receiving for the rest of your beneficiary's life. So it pays out the same amount over 2 lives until their death. And the joint and survivor is 50%, or 50% means that at your death, as the annuitant, the beneficiary would receive half of what you were receiving, or 50% for the remainder of their life. And then the pop-up provision is something that applies to your pension that, let's see. This specifically applies when the beneficiary dies within the first 5 years and they choose a joint payout. It pops it up to the single life payout. So you've got to make a decision on what you're going to do with your pension when you retire. And remember that that's a one-time decision. So you want to choose wisely. And a lot of people don't know how the joint payout works. Essentially, what's happening with a joint payout is that the company is buying a life insurance policy on the life of the annuitant, the owner of the pension, so that at their death, it pays out a lump sum that would pay the remainder to the beneficiary. Well, the idea of a pension maximization is that you can do this on your own. You could take this single life payout and you can buy your own life insurance. And your objective is to pay out the joint and 100% survivor amount for the remainder of your beneficiary's life. So it's a lump sum present value calculation of basically a deferred or an annuity amount. So you can do a calculation to determine how much money you need as a lump sum to pay out for your beneficiary's life. So here's an example of this. You have a single life payout of $28.75, joint 100% survivor of 2010. So what's common is, and it makes sense, is that if you choose a single life, that's your most or your highest payout. That's the one that gives you the most amount of money. The joint 100% survivor is the lowest payout because it's paying out over 2 lives the same amount of money. And then the difference between these two is $865. So $865 is the amount that you don't get when you choose the joint 100% survivor. That's on a monthly basis. And again, this is a hypothetical example, folks. So you choose the single life payout and it's $28.75, or you choose, and then in this strategy, let's see, or you can choose the other option, which pays out to both lives. But when you do the pension maximization, you choose the single life payout. And then again, you get a life insurance policy that has a cost of $865 per month. That's the requirement to beat the joint payout. The cost of the insurance, the life insurance, has to be less than $865 a month. And in doing so, that's $10,380 annually. You're trying to determine the amount of life insurance that you need to buy based upon the joint payout. And again, that's $2,010 per month is what you're basing the calculation off of. And so what will happen is that when the beneficiary, in this case, Julia, so Bob is the annuitant, Julia is the beneficiary. If Bob dies, Julia dies first, Bob can simply cancel the life insurance policy and retain the $28.75. So what this allows you to do is, after that 5-year pop-up provision, you're stuck at that lower level when you choose the joint payout and then the beneficiary dies first. This allows you to have that option to cancel the life insurance at any time and retain that single life payout. When looking at the strategy, it's important to make sure that you're insurable. So life insurance requires underwriting. And that's what determines your premium ultimately. So you can get quotes that may be very different than what you end up when you actually go through underwriting. So you'd want to do this in advance of retirement and make sure you know what the premiums are before making that decision. And here's again, this hypothetical example. This shows you that those two numbers, a 2875 monthly single life pension or a joint payout of 2010s per month. We've made some other assumptions here. Their current age are 60 for both the annuitant and the spouse. The age of retirement will be 65. They expect to live to 89 and to 90. And so based off of those assumptions and the survivor and the difference between the two pension amounts, which is the amount that we have to work with for the premium, the lump sum required to die in the first year of retirement is $322,000. So that's the amount of money that's going to replace 2010 per month for the remainder of the beneficiary's life. What this provides is a premium amount and a savings in this formula. This shows you that this person would have saved $510,000, assumes a growth rate of 6%, if they chose this strategy. So this can be very lucrative to people who A, are insurable, and B, do it in advance of retirement to make sure that they can choose the right option for themselves. Now, what will happen is that life insurance amount, the death benefit need, will go down as you get older. So what will typically happen is, and you can see here in 90, it's down to 23,000. You can see here the difference between the two payout pensions. You can use a strategy to keep the cost of the insurance down. And so you have two different types of life insurance. You have term insurance. Term insurance is for a specific period of time, 5, 10, 20 years. At the end of that term, that life insurance will end. Versus permanent insurance, permanent life insurance goes through the age of the insured. So it ends after the death of the insured. And so when you're looking at a pension maximization strategy, you want to use permanent insurance for at least a portion of it, because you want that to be able to pay out to your survivor. So what we recommend is using a life combo strategy where you use term and cash value life insurance. And by the way, term insurance is less expensive than permanent insurance. And that's because, otherwise known as cash value life insurance. So permanent insurance is cash value life insurance. It has two components. It has an investment and it has a life insurance component. So the amount of money required to pay premiums is higher for cash value life insurance because it has those two components. Term insurance is just straight life insurance, so it requires less premium to get the same amount of death benefit. So to bring the total premium down, you can do a combo strategy. So using both term and permanent insurance or cash value life insurance. So typically what we use is a 20-year term life insurance policy, and then a permanent life policy for a certain amount of money. And that amount of money is based off of the 20th year need. So you simply go back to that chart and you look at the 20th year and you see it's 121,833. That's the amount of life insurance that's needed in the 20th year. And so what's going to happen is the 20-year term life insurance is going to fall off in the 20th year. And you subtract the initial amount. So 322,000 was the total death benefit need. The 20th year need is 121,000. So those two subtracted is $200,000. So you purchase a 20-year term for $200,000, and then a permanent life insurance policy for $122,000 roughly. So in 20 years, again, the term expires, and then the permanent life would continue from where that term left off. Again, that's a way to keep your premiums low and make this a much more effective strategy for people who are trying to take this or utilize this pension maximization strategy. This goes through the math of it, but in this example, this person is saving, let's see, $7,847 per year. That's the additional amount that they get because the life insurance is actually less money than the difference between the two pension payouts. So that's the true advantage of this, is that if the life insurance is lower, the cost of insurance is lower than the difference between the two pension payouts, then I'm actually gaining money. In this case, this person's making $7,847. Very lucrative for the people that take advantage of it. So takeaways, folks, if you have a pension, be sure and look at the pension maximization strategy. We have a calculator on our website, strittmatterwealth.com, that you can run the calculations yourself if you'd like. But great strategy. We use it all the time. Lockheed Martin 401k savings plan. Let's move on to the next part of this presentation. And, oops, went backwards there. The Lockheed 401k plan is a great tool to save for your retirement. So Lockheed matches 50% of the first 8% of your contribution. It's like free money, folks. You definitely want to take advantage of your match. You can contribute up to $23,000 in 2024 for your salary deferral, as well as $7,500 for catch-up contributions if you're over the age of 50. So in 2024, the maximum is $30,500 that you can put in through salary deferral and catch-up. You can contribute either pre-tax or post-tax or Roth. So you have those options. Pre-tax simply means you don't pay tax on the contribution today. You'll pay tax when you pull it out in retirement. And then post-tax and Roth, you don't pay tax today. And even in any case, most people will roll the post-tax and the Roth to their Roth IRA, and then they'll never pay tax again on the money. And I'll tell you more about that in just a minute. Now in 2026, the catch-up contribution is going to be required to go into your Roth if your wages are more than $145,000. So that's a new law that's been in place. This just shows you the matching component and how you get more by contributing 8%. So be sure and contribute at least 8% to your 401k, folks. That way you get the full match. And then what's unique about the Lockheed 401k is you can actually contribute more than the IRS limit. You can contribute up to 40% of your base pay. Now, it is limited to the maximum contribution, which in 2024 is $73,500 if you're over the age of 50. This is a tool that a lot of Lockheed people use, folks, to save money for retirement, especially in their catch-up years when their kids are out of college and paid for and they're off the payroll. This is where people kind of get in high gear and they start saving to this 401k aggressively. So again, the ability to do this means that you can put a lot of money into a tax-deferred vehicle. And by the way, where those additional contributions go is into the post-tax component of your savings plan. So all of those dollars will not be, they'll be taxed now on the principal, but what will happen in the future is that won't be taxed again, because when you retire, you can roll it to a Roth IRA. And that's something that's unique as well. All of your post-tax dollars in your 401k can be rolled into a Roth IRA. So when we typically have a client retire, we get two checks. We get their pre-tax and we get their Roth check based upon how they save to their 401k. Something also important to do is to name beneficiaries on your 401k. So your 401k plan is unique, and that it has a beneficiary designation. It's called a direct transfer asset. And what that means is that it avoids probate when you name a beneficiary. So the beneficiary, all they have to do at your death is provide the death certificate, and then they will transfer that into their name. You can also name contingent beneficiaries so that if the primary beneficiary predeceases you, that contingent beneficiary will take over. So be sure, and if you're going to use a beneficiary designation rather than just your will, be sure and have that designation on file. I would always recommend printing it putting it on file with your other estate planning documents so that your executor knows what that is. If you're going to do through your will or even through a trust, just keep in mind that would have to be probated. So when done through the will, so the beneficiary designation allows you to avoid probate. Let's talk about the company stock strategy. So if you have a 401k plan, you can, and you saved into it and into Lockheed stock specifically. So you purchased Lockheed stock in your 401k plan. There's a strategy called net unrealized appreciation. And this is a unique strategy that allows you to roll your stock out of your 401k and into what's called a non-qualified account, so a taxable account, not an IRA, in other words. And in doing so, you're going to pay tax on the amount of your basis, so the price that you paid for the stock when you purchased it, not for today's value. And you're going to pay ordinary income tax on that amount. And then when you sell that stock, assuming you sell it later, all of the gain that you have will be taxed at long-term capital gains tax rates. Now, you do have to hold that stock for 1 year from when you roll it over. But when you sell it, it would be taxed at long-term capital gains tax rates. So this is a unique tax kind of benefit to you that requires you to do some calculations. This doesn't work for everybody, but we always look at the Lockheed stock in a 401k and run a net unrealized appreciation calculation to make sure that it's not more advantageous just to roll that stock out and pay tax at these lower tax rates rather than just rolling it into the IRA and growing tax deferred when you retire. So a lot of that will depend upon what tax rate you're going to be in once you retire. There's also some other things that go along with it, so it's not as easy as I made it sound, but we can help you go through all the different intricacies of it to help you make a good decision on that. Okay, let's move on to retirement health care. You know, would somebody do me a favor? Can they type into the chat feature real quick just to make sure it's working? Sometimes this is hit or miss. And actually, I just saw this. Now you can chat with me. I just figured this out. Okay, so if you have questions, I apologize. You're welcome to put those into the chat feature now, and I'll answer this. And there's one. I already have one. Okay, it's a hello. Hello, John. I appreciate you doing that. Let's talk about retirement health care. So with Lockheed, you get some unique benefits. The first is that, and this isn't for every employee, so this will depend on the type of employee that you are. You can check with your HR to determine what you're eligible for medical coverage. But you can get a medical benefit. By the way, here's the phone number. That third bullet point down is the phone number you can call, where they will subsidize your health insurance once you retire from Lockheed. So when you're comparing your health insurance, a lot of people will compare their coverage to outside coverage. Keep in mind that Lockheed will provide a subsidy to the insurance amount once you've retired. So very important for you to know what that is. And then secondly, to compare that to outside coverage. Now, remember, what's often confusing to a lot of people is that there are no more pre-existing conditions. So the fear used to be before the Affordable Care Act was, well, you know, if I don't take this, then I'm stuck. If something happens to me and I'm uninsurable, I can't go get coverage elsewhere. And that's not true anymore. Everybody is guaranteed insurable under the Affordable Care Act. Where you're guaranteed insurable at is the healthcare.gov website. So the government plan that's available, I think it's through Blue Cross Blue Shield. So you can get quotes from that plan through a health insurance agent and compare that to what you're going to be paying through Lockheed. And again, you don't need to worry about losing Lockheed coverage because you will be guaranteed insurable through the government plan. And again, I'm talking about pre-age 65, right? Pre-Medicare age, because we're going to talk about Medicare benefits in just a minute. So again, be sure to look at that, folks. I do see a question here. So the question is, how do I insure my spouse that is not 65? So you can continue coverage through Lockheed. That's one reason why people do that. Or you can get coverage on the healthcare.gov website for your spouse. And you're talking about once you reach 65. So 65, you're going to go on Medicare, and that Lockheed benefit is there, or you can go through healthcare.gov. So for those of you that are Medicare age, you are eligible for another benefit provided by Lockheed. So they provide a health reimbursement arrangement to offset some of the cost of your Medicare Part B. Medicare Part A is free. Medicare B has a premium. And this is, there are some stipulations to this. So you've got to obviously apply for your Medicare benefits. And then, and this is for supplement plans, actually. So they provide a supplement for supplement plans through this program. Medicare has supplements, I think it's A through N now. I don't deal with Medicare, but that said is that those supplement plans have a cost. And so this provides an offset to those costs. So again, you can call that same phone number right there to find out about that benefit for you, the 866-562-2363 under bullet point 3 there. And they can tell you about that benefit for you. And that's your health insurance. So the health savings plan is a tool that's used for high deductible health insurance. So Lockheed got high deductible health insurance a few years ago, and this made you eligible for a health savings plan. And folks, these are a great tool. So these are a tool that you save to, and in doing so, you make your election during your enrollment period. And you can contribute up to the IRS limit. So in 2024, it's $4,150 for single and $8,300 for family. So if you're over the age of 55, there's $1,000 per year catch-up contribution. So now it's $9,300 or $5,150. And the benefit of this is that you save pre-tax dollars. So these dollars go in pre-tax. And you can use them tax-free for medical purposes. There's no tax on the distributions when it's used for medical purposes. What's also beneficial about this is when you save through Lockheed, you also don't pay FICA taxes. So FICA taxes are 7.65% of your pay. So whatever your income tax rate is, say it's 22% plus the 7.65%, now you're saving 29.65% on every dollar that you put into this plan. So a lot of people think you'll lose these dollars when you retire. You don't. You can take them with you. You can roll them to your own plan. You can also open up your own HSA plan if you didn't elect the proper amount in the beginning. And you can go set up your own plan and just contribute the maximum to your separate plan. So the other unique thing about these two is when you turn 65, you can use them for non-medical related expenses without penalty. So if you do it before age 65, there's a 10% penalty plus taxes. If you do it after 65, there's no 10% penalty, but there is taxation of ordinary income tax. And again, we use it for medical, there's no tax, no penalty. So fantastic benefit for people who are using a high deductible health insurance plan. Also, by the way, when you roll these over, you can invest the money. So you can go into mutual funds, stock, whatever you want to, depending on the plan that you're going into. And that's the HSA Health Savings Account. Health Savings Account, that's different than the flexible spending account, folks. That's a totally different plan. Okay, let's move on to portable insurance. So portable insurance is insurance that you can take with you once you retire. So in Lockheed, you have several options for insurances that you can take with you. So your employee term life insurance, that's a annually renewable term and life insurance policy. You have your group universal life policy, which is a permanent policy. You have special accident policy, dependent optional term life insurance on dependents, and then supplemental medical, long-term disability, and long-term care. Your long-term care plan is really, it hasn't been offered in many years. but you can certainly take, if you were there in the early days, you got it, you can take it with you. So what's unique about portability is proof of insurance typically is not required if you're not making any changes. If you add insurance, that's typically when proof of insurability is required. Okay, let's talk about the top 10 retirement mistakes. So the first is not taking advantage of your full 401k match. Folks, this is a no-brainer. Get your free money, put in your 8%. Not taking vacation and then retiring. So this is the idea of being able to spend down your vacation first and basically receive that as income before you retire. Not using the pension maximization strategy that we talked about today. Not using post-tax portion of the 401k to save more money. So again, that additional amount that you can save as Lockheed employees is quite beneficial to you. Not rolling post-tax portion of your 401k over into a Roth. So remember that you've got to remember to do that. So if you roll your 401k to an IRA, when you leave your company, the post-tax, you need to tell them to roll it, it's going to go into a Roth IRA. Not naming a beneficiary. So again, that causes lots of problems where people have to probate the 401k. Not taking advantage of net unrealized appreciation if you've been purchasing Lockheed stock. Not using Lockheed Martin healthcare and Medicare benefits that we've talked about. Not contributing the maximum to your health savings account. Not utilizing Lockheed Martin Guaranteed Universal Life Insurance. So a little bit about that is you can use that to help you do the pension maximization. That's permanent insurance that you can take with you for the rest of your life. And then bonus, not using us to plan your retirement. So we can definitely help people to plan their Lockheed Martin retirement when they're ready. So what are your next steps? Well, hopefully you've learned a few things today that will be beneficial for you. So I would begin to gather information, write down your objectives and questions based on what you've learned in today's class, and take action. So if you'd like our help, request a complimentary consultation to begin your retirement planning and see if PenMax strategy will work for you. What we offer is comprehensive financial planning, tax planning, estate planning. We are certified financial planners. We charge a flat fee for financial planning. And then for investments, we are an independent registered investment advisor firm. We have no proprietary products, no affiliations, so therefore no conflicts of interest. We use institutional style investing. So what that means is we invest with very large investment companies that typically have minimums of $1 million to $10 million. You don't have to reach those minimums. And then we charge a flat percentage based on the asset levels. And then the insurance is, we have an independent insurance agency, so we can help with long-term care insurance and life insurance as well. You can request a consultation to learn more. We also have a blog that you can go to our website, strittmatterwealth.com, and check out. You can sign up for our e-newsletters on the website as well. And then if you enjoyed this webinar, you can enroll some of our classes we teach out at UTA and TCC and Tarleton. Estate planning, Social Security, retirement, different classes on those as well. Go to strittmatterwealth.com to find out about our future educational events. Like us on Facebook, we post all of our events on Facebook as well. And you'll see what's coming up. Question, let's see. Yeah, we'll send the presentation, not the slides. So this is a recorded presentation. We'll send the presentation to all of you today. Okay. Any other questions? Trying to think of what else I can tell you today that will be beneficial for you. Stock market's doing well. Hopefully you're taking advantage of it. We've seen a nice recovery in the last few months. Thank you. I appreciate that. I would tell you, so one thing I'll mention is we've got an estate planning class happening right now at Tarleton. It's the next 2 Fridays at 1 o'clock. You can go to our website to sign up. So strittmatterwealth.com, well, you'll be able to quickly find it. That's a 3-hour class on estate planning taught by Kelly. And it's a wonderful class if you're trying to put your wills and trusts and estate planning, all that stuff in place. This will put you on the right track. We've got a Social Security class coming up in the next in March. So we're in March now. So it's coming up very soon. And then we've got retirement classes coming up as well. Well, folks, I don't have any more people asking any questions in the chat. Let's see. Oh, let's see. Lockheed number again. And live in, so no classes. I don't understand your question there. I'm sorry. It says, and live in MD, so no classes. I'm not sure what that means. But if you're looking for the Lockheed phone number that I gave out earlier. Oh, you live in Maryland. I'm sorry. Okay, I get it now. Yeah, so we do our classes. Well, I should say we haven't done them in a long time digitally, but we're about to start again. So if you sign up on Facebook, if you like us on Facebook, you'll be alerted as to when the classes are. You can also go to our website of those classes as well. And we should be doing those classes on the internet, so digitally very soon. And there's that phone number. I think that's what you were asking for, is 866-562-2363 for the Lockheed Employee Service Center. Any more questions? And our phone number, by the way, is here if you're asking for that, 817-210-3444. You can also email us at info@strittmatterwealth.com. If you'd like to contact us to request a consultation, that's an easy way to do it. By the way, I did mention that real quick. The consultation, that's basically a 2-hour meeting where we sit down, either live or in person. We talk about your goals and objectives, what you're trying to achieve from a financial standpoint, and then talk about how we can help you with different strategies that we use with other clients. So like the pension maximization, we've got some unique investment strategies. We have a real estate firm also where we invest in real estate for clients. So we do a lot of different things for our clients that are unique, I think. But yeah, if you'd like to meet with us, just simply send an email there, give us a call. We're happy to meet with you. All right. I don't see any more questions. So I hope you all have a great weekend and look forward to talking with you in the future. Thank you very much. Bye-bye.